Hi everyone, Mike Riley here. All this month I've been focusing on critical illness, just trying to give you some more information about why it's important and some of the uses that it can have as part of an overall financial plan. Today's the last day of the month, and I wanted to talk about something that I think may put it in a slightly different light, and that is critical illness as a protection for your existing assets. And I was inspired by a story in today's paper about a family that's been dealing with the struggles of their daughter, and she had been in an accident and the financial impact that it took on the family. My heart goes out to them. It's unfortunate that this is something I see a fair amount, probably because I pay attention to it. But in many cases, families are using up all of their savings. They're going to family members who, out of generosity, help them, and then the community comes together. But in many cases, a critical illness or an accident in a family, especially if it happens to a child, is something that through the tools of critical illness we can really put together. But I know a lot of parents are reluctant to talk about it and may even see it as an expense. So I'd like to frame it in terms of protecting an asset that everyone can understand, and that's an education savings plan, an RESP. So just taking a look at a typical situation, we've got, think of a 3-year-old girl, and on average, the parents that I work with are putting in about $75 a month or $900 a year into an education savings plan. The numbers don't really matter, just for the purposes of illustration. It can be more, it can be less. Now, with the grants that are available, there's a $1,200 grant in BC when a child turns 6, plus the matching grants from the Government of Canada. By the time that this young lady is ready for university at age 19, we could expect that that could be worth about $32,000 of education savings. Now, of course, that's based on an average rate of return of 5%, which is never guaranteed, could be more, could be less. But it's not out of the realm of possibility to think that that would be available for education. And that's fantastic. But what happens if the little girl in our scenario here becomes sick or injured? And let's say it happens at age 7, and the family needs money because either to compensate for time off work, for travel to Vancouver to seek treatment, if they have to make changes in the home to put in handicapped accesses, ramps, outfit a bathroom. In many cases, this is the first place that a parent will go to try and get money out from their savings. But they don't have all of that money. So if this happens at age 7, they've been saving for 4 years, they've really only put in $3,600. Now, when you look at the statements from the bank, it might look like there's $7,000 in there, but a lot of that money is grant money from the federal government and the provincial government. That all has to go back. So by taking money from the RESP, which was intended for education, that could have been worth $32,000, if this happens at age 7, they've only got $3,600, sorry, that they can access. And that doesn't really go a long way. So what I propose is let's look at protecting our RESP with a child critical illness policy of the same amount of the expected gain of $32,000. We put a wrap around the RESP of critical illness so that if something happens to our young lady in the scenario, the critical illness triggers a payout of $32,000, and we can protect those education savings so when she recovers, it's still there for when she goes to university. What was that cost? Assuming a standard health rate for a 3-year-old female would be about $11 a month. So for $11, you can protect an asset worth $32,000 down the road. So right there, I think it makes sense from $75 a month to add an extra $11 just to make sure that we can use that. But there's something else that we can do as well. There is a feature called return of premium that we can wrap around the critical illness and the RESP, which by the time the child reaches age 25, if she hasn't claimed on it, if she hasn't gotten sick and they have had to use the critical illness benefit, the parents get all that money back again. This the same scenario would be approximately $18 a month to add the return of premium. You get that back. You get the $11 back. I sound like a salesman at this point, but it is true. So at age 25, that would be approximately $6,600 that's been put into the critical illness plan over over the lifetime of the plan. So if she never gets sick and they never did anything, that's fantastic. That's the best case scenario. It's $32,000 that's available for education. But if she does get sick, this is something that can protect that, either just through the straight critical illness policy or turn it into a savings plan by adding the return of premium. And at age 25, there's an additional $6,600 that comes back. The parents can use that. They can give it as a gift. But you've now increased the benefit overall of this financial program just by doing that. So just to finish off the month, critical illness is something that at least we should talk about. If you decide that it's never something that makes sense to you and you never think that you're going to get sick or a child is never going to get sick, of course you don't need it. We all have home insurance and car insurance, and we hope that we never have our house burned down or get into a car accident. Critical illness is much the same way. So I hope that this has been an educational month, that I've given you some things to think about. Please reach out and ask me any questions if you have. I think it's an important thing to think about and should at least be thought about in your financial planning. So that's Mike Riley with Freedom 55 and Altitude Financial, helping you gain altitude and gain confidence.